Imagine stepping up to a microphone, right, and telling Wall Street you just lost $8 million in a single quarter.
Yeah, that is rough.
Right. Your gross margins have basically collapsed by over 1,000 basis points. And severe winter blizzards have effectively frozen your core installation operations.
Literally frozen them.
Literally. And your general and administrative expenses have completely skyrocketed. But then, without missing a beat, you look at those same investors and promise them a record-breaking $100 million revenue year with like high teens EBITDA margins.
I mean, it is a staggering level of cognitive dissonance if you were just casually reading the press release.
It really is.
You were looking at a classic scenario where, the trailing indicators point to a company in free fall, but the forward-looking guidance points to this hyper-growth tech darling.
Exactly. Well, welcome to this deep dive, everyone. Today, we are bringing you a special Talk Tickers edition.
That's right.
So for those who are new, this is our data-forward, no-nonsense breakdown designed specifically for retail investors who want to understand the mechanics beneath the headlines.
Because the headlines can be deceiving.
Absolutely. We are ignoring the emotion, we're bypassing the corporate spin, and dissecting the actual accounting realities of publicly traded companies.
And the focus today is really a textbook case study in why relying on algorithmic screeners or like top-line news alerts will consistently lead you astray.
Oh, 100%.
We have to separate the structural long-term operational shifts from the one-time chaotic events of a corporate turnaround.
So the target today is Creative Realities, Inc. Ticker symbol is CREX. We are actively analyzing their Q1 2026 earnings conference call and the accompanying financial filings.
Right.
My role here is to challenge the numbers, play devil's advocate, and really figure out if management is constructing a house of cards.
And my objective is to provide the clinical objective context. I mean, we will translate the accounting frameworks, the acquisition integration mechanics, and the underlying unit economics of their major pipeline announcements.
Just to see if the math actually supports their incredibly bullish outlook.
Exactly.
Okay, let's get straight to the raw Q1 data. If you are holding this stock and you just glance at the top-line summary in your brokerage account, you might actually feel a surge of confidence.
You might, yeah.
Because they posted total revenue of $16.3 million in Q1. That is a massive leap from the $9.7 million they reported in the exact same period last year.
It's huge.
On the surface, nearly doubling your quarterly revenue is a phenomenal headline.
It looks phenomenal until you apply basic financial scrutiny. You have to trace the origin of that capital.
Right. Where did it come from?
Exactly. Did Creative Realities generate an additional $6.6 million through organic sales of their existing product lines? Well, the financial disclosures say no.
Not at all.
The CFO, Tamara Koshua, explicitly outlined that $7.9 million of that $16.3 million top line was generated entirely by their recent acquisition of Cineplex Digital Media, or CDM.
So they bought the revenue.
Precisely.
They essentially used capital to bolt an entirely separate income stream onto their balance sheet to mask what is happening underneath.
Yeah, I mean, that is the mechanical reality of merger and acquisition accounting. Right. When you acquire a revenue-generating asset, your top line inflates immediately.
Right.
However, when you strip away the CDM acquisition and isolate the legacy Creative Realities business, the core operations they were running prior to the merger, their organic revenue actually decreased by roughly 15% year over year.
See, that is wild. A 15% drop on the legacy side isn't just some minor blip.
No, it's not.
That signals a structural contraction in the core business. If the foundation is shrinking by double digits while management is, distracted by the shiny new toy they just bought, that is an immediate red flag for any retail investor.
It certainly warrants intense scrutiny. A 15% contraction typically indicates one of two things.
Okay.
Either they are losing market share to competitors in their legacy verticals, or management has deliberately diverted sales resources and capital away from low-margin legacy products to focus entirely on the new combined entity's pipeline.
Which would make sense.
Yeah, but we will need to look at their margin profile to determine which scenario is more likely.
And that margin profile leads us directly to the bottom line metrics, which are, they're incredibly difficult to digest.
Very messy.
They posted a net loss of $7.9 million for the quarter. That translates to a loss of 74 cents per diluted common share.
Ouch.
Yeah. And if you look back at the first quarter of last year, they posted a net income of $3.4 million.
Well, for the sake of analytical rigor, we really must contextualize that historical figure.
Fair enough.
That $3.4 million net income from the prior year was artificially inflated by a $4.8 million one-time gain. Yeah, it stemmed from the settlement of a contingent liability. It wasn't operating profit.
I see.
But, I mean, even accounting for that anomaly, a swing to an $8 million quarterly net loss is a severe degradation of the balance sheet.
The adjusted EBITDA metrics confirm that degradation, too. Earnings before interest, taxes, depreciation, and amortization, which, analysts use to gauge the raw operating cash flow of the business by stripping out non-cash expenses, that swung from a positive $500,000 last year to a negative $500,000 this quarter.
So they are burning cash at the operating level.
Exactly. Okay, let's unpack this. If total revenue is up from $9.7 million to $16.3 million, even if we know a huge chunk of it is acquired, why did the gross margin completely crater?
It's a great question.
Because it collapsed from 45.7% down to 34.2%. In theory, bolting on $7 million in revenue should create some economies of scale, right? Not compress your margins by over 1,000 basis points.
Yeah, that is the central paradox of this earnings report. To understand a margin collapse of that magnitude, we had to transition from the raw data into the operational mechanics.
Right.
Gross margin doesn't just evaporate. It is mathematically tied to the cost of goods sold. And in Q1, their cost of goods sold was heavily skewed by two specific anomalous factors.
Okay, let's isolate the first factor.
The primary driver was a fundamental shift in their product mix. In the digital signage sector, revenue is split into two distinct categories: hardware and software.
Okay.
The CFO stated that the margin compression was primarily driven by a higher volume of quick service restaurant or QSR deployments.
So like fast food chains, drive-thrus, digital menu boards.
Correct. When you deploy a QSR contract, the initial phase is entirely hardware-centric.
Because you're buying the screens.
Yeah, you have to procure commercial-grade outdoor displays, localized servers, mounting brackets, and weatherproofing enclosures.
Sounds expensive.
Very. You have to physically ship tons of steel and silicon across the country, hire localized labor to pour concrete footings, and run electrical conduit.
Wow.
The gross margin on that physical infrastructure is inherently low. It is incredibly capital intensive.
Right, because it is a tangible physical supply chain, whereas their SaaS revenue software as a service is entirely different.
Completely different.
Once the proprietary software platform is coded, licensing it to an additional 10,000 screens costs almost nothing in overhead. The margins on software are massive.
Exactly.
So what we are seeing is that physical hardware constituted a much larger slice of the revenue pie this quarter, which mathematically drags the blended gross margin down.
That is the exact mathematical mechanism, yeah. A heavy deployment cycle always suppresses margins in the short term. But there was a second acute factor hitting the cost of goods sold.
The penalty.
Right. They absorbed a $500,000 one-time penalty to terminate an outsourced legacy CDM installation vendor.
I mean, if you are paying $500,000 simply to sever ties with a subcontractor you literally just inherited, that screams of sloppy due diligence during the M&A phase.
It doesn't look great. Yeah.
Why acquire a vendor network just to pay massive termination fees to dismantle it?
Well, it is a valid critique, but we have to look at the realities of post-merger integration. During the due diligence phase of an acquisition, you are analyzing high-level financial health, intellectual property, and client contracts.
You're looking at the big picture.
Yeah. It is nearly impossible to vet the ground-level operational competence of every single localized subcontractor a target company employs.
So they close the deal, open the hood, and realize this specific vendor was a massive liability.
Precisely. They likely discovered that this installer was failing to meet Creative Reality's deployment standards, or maybe causing friction with clients, or operating with an incompatible cost structure.
Makes sense.
When integrating a merger, management faces a choice. Allow a subpar vendor to slowly bleed your reputation and delay installations over a 3-year contract, or take the financial hit immediately, buy out the contract, and replace them with a vetted partner.
Rip the Band-Aid off.
Exactly.
So they opted for the immediate amputation. It hurts the Q1 balance sheet, but it removes the localized friction.
Right.
But, even with a hardware-heavy mix and a $500,000 breakup fee, there is still a massive revenue hole here. Management claimed on the call that $4 million in expected revenue wasn't permanently lost, just delayed due to weather.
The weather excuse.
Yeah, I have to push back here. Weather is the oldest, most convenient excuse in the corporate playbook. If a tech company's supply chain and installation pipeline are so fragile that a February snowstorm derails a quarter, is this a fundamental flaw in their operational resilience?
Under normal circumstances, the weather excuse deserves intense skepticism. However, we have to analyze the specific accounting rules governing their revenue recognition.
Okay, lay it on me.
Creative Realities is bound by GAAP generally accepted accounting principles, specifically ASC 606.
Right, ASC 606.
Under ASC 606, you cannot recognize revenue simply because a client signs a contract, or even when the hardware leaves your warehouse.
Because the performance obligation hasn't been fully satisfied.
Exactly. For outdoor QSR deployments, the revenue can only hit the income statement once the concrete is poured, the screens are mounted, the software is integrated, and the client formally accepts the operational site.
Oh, so it's a very high bar.
Very. And CEO Rick Mills detailed that severe, anomalous snowstorms paralyzed construction across North Carolina and the broader Southeast corridor.
You cannot pour concrete footings or trench electrical lines when the ground is frozen solid.
You really can't.
Or when municipal permitting offices are closed due to a state of emergency. It's like a postponed flight, right?
That's a good way to look at it.
You are still taking the trip and paying for the ticket. You're just arriving in Q2 instead of Q1.
Exactly. The physical reality of the work prevents it. Furthermore, it wasn't just the Southeast QSR deployments.
There was more.
Yeah, Mills noted that a massive 500-location contract for state lottery customer was scheduled for Q1 installation. Logistical delays tied to those same weather patterns pushed that entire deployment block.
Okay, this is a critical distinction for the retail investor to model correctly. We are looking at supply chain bottlenecking, not demand destruction.
Correct.
If a client cancels a contract, that revenue is permanently erased from the valuation model. But if the contract is signed, the hardware is sitting in a staging facility, and the localized labor is just waiting for the ground to thaw, that $4 million is going to aggressively cascade into the Q2 and Q3 ledgers.
It is a deferral, not a deletion. And that deferral means that subsequent quarters will look artificially inflated, just as Q1 looks artificially suppressed.
Right.
The capital is merely shifting across the quarterly boundaries.
So we have isolated the gross margin compression, the heavy hardware mix, and the $500,000 vendor termination, and we've accounted for the $4 million in deferred installation revenue.
Yes.
But that still leaves us staring at an $8 million gap on the bottom line. Where's the rest of the cash bleeding out?
That gap is driven entirely by the general and administrative expense line, or G&A.
Overhead.
Yeah. When a company executes a major acquisition, the immediate financial aftermath is chaotic. Their G&A spiked violently from $3.9 million in the first quarter of last year to $8.9 million this quarter.
A $5 million jump in pure overhead. What specific mechanics drive a G&A spike of that magnitude during a merger?
It is the cost of carrying redundant infrastructure. When Creative Realities absorbed CDM, they onboarded roughly 250 employees.
Wow.
Yeah. And for a period of time, you were operating two parallel corporate structures. You were paying two different legal teams to handle the transition, two accounting departments to reconcile disparate ledgers, and you were paying for redundant enterprise software licenses across both organizations.
So you have two CFOs, two HR directors, two completely separate payroll systems.
Exactly. And you are also absorbing the severance packages and restructuring costs associated with eventually eliminating those redundancies.
But management isn't just accepting a permanently bloated cost structure, right? They explicitly stated a mandate to extract $10 million in annualized cost savings out of the combined entity by the end of 2026.
They did.
This is the classic Wall Street definition of realizing synergies. You merge the data centers, you consolidate office leases, you transition everyone onto a single CRM, and you trim the redundant middle management.
The critical data point here is their execution speed. CEO Rick Mills reported that as of March, they have already achieved 60% of that $10 million cost-cutting goal.
Wait, if they have already successfully executed $6 million in permanent recurring cost reductions, why isn't that massive saving reflected in the Q1 bottom line?
Because the timing of restructuring expenses naturally lags.
Yes, what do you mean?
Well, if you close an office lease or offer a severance package in February, you pay a penalty or lump sum payout up front. The expense hits Q1 immediately.
Oh, I see.
Right. The savings, the lack of rent or salary payments, accrues slowly over the subsequent 12 months.
That makes sense.
You see the maximum financial pain of the integration in the first quarter, but the operating leverage generated by those cuts won't begin to radically improve the EBITDA margins until the back half of the fiscal year.
Okay, that sets up a fascinating narrative pivot. We know they have $4 million in deferred revenue violently swinging into the next quarter.
Yep.
We know they have stripped millions in redundant overhead that will soon begin padding the bottom line. And that context is absolutely vital when we evaluate management's forward-looking statements.
It's the only way it makes sense.
Right, because despite sitting on an $8 million Q1 loss, here's where it gets really interesting. Management laid out guidance projecting over $100 million in total 2026 revenue, accompanied by adjusted EBITDA margins expanding into the high teens.
I mean, going from a negative adjusted EBITDA in Q1 to a high teens margin profile for the full year requires an operational flawless execution over the next 9 months.
It's a tall order.
Very.
Yeah.
In the digital infrastructure sector, a high teens EBITDA margin implies extreme software leverage.
If I'm allocating capital, I do not accept a $100 million projection without demanding to see the underlying architecture of the deal flow.
Nor should you.
Management cannot simply point to cost cuts. Right. They have to prove they have the contracted pipeline to hit 9 figures. So let's break down the receipts vertical by vertical.
We will begin with their sports and entertainment vertical. They announced an $8.5 million contracted deal to operate as the official digital signage provider for the Tennessee Titans' new Nissan Stadium.
Okay, let's dissect the mechanics of a stadium deal, because it is vastly more complex than just hanging televisions in a living room.
Oh, vastly.
They are deploying the IPTV framework Internet Protocol television alongside thousands of individual displays.
An IPTV deployment in a modern NFL stadium requires an incredibly sophisticated network architecture.
How so?
You are routing uncompressed 4K video feeds, real-time localized advertising, dynamic concession pricing, and emergency broadcast overrides across a massive localized network, synchronizing thousands of endpoints with near zero latency.
The bandwidth management alone is a massive undertaking.
Insane.
And the timeline on this is tight. The new Nissan Stadium is slated to open in February of next year. That means a heavy physical installation, the pulling of fiber optic cables, the mounting of the chassis has to happen now.
Exactly. Consequently, the vast majority of that $8.5 million contract will be recognized as revenue within this calendar year as they hit specific installation milestones.
Okay.
But the true value of the Titans deal isn't just the immediate cash flow. It is the reference architecture.
The ultimate showroom effect.
Precisely. Creative Realities already manages the digital infrastructure for the Dallas Cowboys, which involves 3,300 screens.
Right, Jerry World.
Exactly. Adding the Titans proves they can execute at the absolute highest level of live event logistics. When other NFL ownership groups authorize multi-billion-dollar stadium upgrades, the competitive bidding process for the digital infrastructure is small.
Because it's so specialized.
Right. If you have successfully deployed the Cowboys and the Titans, you become the default de-risked vendor for the rest of the league.
And management explicitly noted they're actively pursuing multiple other NFL franchises.
They are.
But, the stadium business is highly cyclical. You don't build a new stadium every year. Let's look at their broader entertainment vertical. They secured a $6.5 to $7 million partnership with AMC Theaters and National Cinemedia, or NCM.
So NCM operates as the dominant cinema advertising platform in the United States. They control the pre-show inventory, the ads you watch while sitting in the auditorium.
Like the 20 minutes of trailers and commercials.
Exactly. However, this specific contract targets an entirely different ecosystem, the theater lobby. Creative Realities is contracted to deploy 1,200 screens across 285 AMC locations.
The logic behind lobby monetization is brilliant.
It really is.
The dwell time is high. You have a captive demographic waiting in line for concessions or just lingering before their auditorium opens. It is prime, high-impact real estate for brand storytelling, but historically it has been monetized poorly with, static cardboard standees.
And Creative Realities is not acting as a simple hardware vendor here. They are integrating their proprietary AdLogic AdTech solution.
Okay, what does that do?
They are providing the underlying programmatic software engine that interfaces with demand-side platforms, allowing advertisers to dynamically bid on and serve highly targeted video inventory to those specific 1,200 screens based on the demographic data of the movie currently playing.
Oh, wow. So if a family animated film is letting out, the screens screens dynamically shift to advertise theme parks or toys, whereas an R-rated thriller triggers luxury car or alcohol advertisements.
That is the power of the AdLogic software. And again, the timeline is immediate. That 6.5 to 7 million in deployment revenue is expected to hit the books this year.
Fast execution.
Furthermore, the CEO heavily implied that if the AMC rollout yields the expected CPM's cost per mil, or the cost an advertiser pays for 1,000 views, they will immediately utilize that data to aggressively pursue Cinemark and the other major exhibition chains.
So the pipeline is clearly robust in the event space. 8.5 million locked in with the Titans, 7 million locked in with AMC.
Very robust.
But the sector that seems to define their recurring revenue model is food and beverage, specifically the QSR space that dragged down their Q1 margins.
The growth metrics in the QSR vertical are undeniable. The earnings call highlighted their expansion with a rapidly scaling drive-through coffee chain called 7 Brew.
Never heard of them, but apparently they're huge.
Well, they're growing fast. Management stated that 7 Brew is currently on track to build and open 750 new locations this year alone.
That is an aggressive footprint expansion. And if we look at the unit economics the CEO provided, every single initial installation generates roughly $8,000 in hardware and deployment revenue.
If you run the basic arithmetic, 750 locations multiplied by $8,000 per site equates to a highly predictable $6 million in top-line hardware revenue for the year, purely from one client's expansion.
But the hardware revenue is just the bait, right? The true valuation driver is the sauce lock-in.
Always.
Once you embed your physical screens into the concrete of a 7 Brew drive-thru and you wire those screens into their localized point-of-sale system, the switching costs become astronomically high. Nobody is carrying out concrete to change a software vendor.
That is the core thesis of their business model. Every one of those 750 new coffee stands must pay a monthly recurring software licensing fee to Creative Realities to operate the digital menu boards, push pricing updates, and manage the localized content.
Which is pure margin.
Yes. That SaaS revenue operates at an incredibly high gross margin and compounds year after year.
But 7 Brew is essentially a startup scaling rapidly. The more impressive operational feat is what they achieved with Dairy Queen.
The Dairy Queen deal is fascinating.
They successfully secured the Dairy Queen North America contract, effectively displacing the prior vendor. And the irony here is rich. The prior vendor they displaced was CDM, the very company they just acquired.
It is a phenomenal example of M&A synergies being executed flawlessly.
How so?
Well, prior to the acquisition, CDM held the contract for Dairy Queen's indoor digital menu boards, which generated roughly $2.5 million in annual recurring revenue. However, they had failed to capture the exterior drive-through business.
Outdoor lanes.
Right. When Creative Realities executed the merger, they leveraged their superior outdoor hardware expertise, went through a rigorous request for proposal process, and convinced Dairy Queen Corporate to grant them the mandate to digitize the exterior lanes.
The total addressable market within that single account is staggering. The CEO noted there are 4,700 Dairy Queen locations operating across the U.S. and Canada.
And guess how many have digital drive-thrus?
As of this earnings call, only 2 of those locations feature digital drive-through infrastructure.
2 out of 4,700.
Unbelievable.
The runway for retrofitting that legacy infrastructure is massive. By expanding their mandate from the indoor screens to the outdoor drive-thrus management projects, they will effectively double the annual recurring revenue from the Dairy Queen account, pushing it from $2.5 million to between $4 million and $5 million annually.
And because Dairy Queen operates on a franchise model, Creative Realities isn't reliant on a single corporate capital expenditure budget. They are selling directly to thousands of independent franchise owners who need to increase their drive-through throughput to offset rising localized labor costs.
Every time a franchise authorizes an outdoor retrofit, it adds anywhere from 3 to 7 additional screens to the centralized sauce subscription pool.
But wait, as mathematically significant as the Titans, AMC 7 Brew, and Dairy Queen deals are, they are effectively appetizers compared to the final catalyst detailed on the call.
The whale.
Yes, the whale. The CEO dedicated significant time to discussing a transformational verbal award in the retail media network, or RMN, space.
If they successfully execute a definitive agreement on this verbal award, It will fundamentally redefine the scale and valuation multiple of the entire company.
Let's scrutinize the scale of this whale deal. The initial phase calls for the deployment of 10,000 screens and 20,000 independent data gathering devices within this calendar year.
Massive.
And the deployment schedule scales aggressively to 60,000 devices by the middle of 2027. The ongoing high-margin SaaS revenue generated by this single client is projected to be between $6 million and $8 million annually.
The sheer volume of endpoints is impressive, but what makes this deployment revolutionary is the specific underlying technology.
Wow, tell me about it.
They are not simply mounting televisions in a retail aisle to play generic video loops. They are deploying an interactive retail media network engineered to deliver closed-loop attribution at the cash register.
Okay, wait, we really need to dissect the mechanics of that because to a retail investor, closed-loop attribution just sounds like pure marketing jargon.
Oh, absolutely.
Like, how does this technology fundamentally alter the value proposition for the actual brands buying the ads?
What's fascinating here is, to understand its value, you have to look at the historical flaw of physical advertising.
Which is?
If a major consumer packaged goods brand, let's say a national beverage company, purchases a highway billboard, they operate in an open loop. They know how many cars drove past the billboard, but they have zero empirical data proving that a specific driver saw the ad, pulled over, and purchased the beverage.
Right. They are estimating return on ad spend based on broad correlations.
It is an inherently inefficient allocation of marketing capital. Then the digital advertising duopoly emerged.
The search engines and social feeds.
Yes. When a brand purchases an ad on a search engine or a social media feed, the platform tracks the specific user's click, follows them to the e-commerce checkout page, and definitively records the transaction.
So they know exactly what worked.
The advertiser knows with absolute mathematical certainty that their specific ad generated a specific dollar amount in revenue. That is closed-loop attribution. It removes the guesswork, which is why digital ad inventory commands such massive premiums.
Okay, so the holy grail for the retail industry has always been figuring out how to drag that internet-level click-to-purchase tracking capability into a physical brick-and-mortar supermarket.
And that is precisely the architecture Creative Realities is deploying for this whale client. The 20,000 data gathering devices are the physical equivalent of internet tracking cookies.
How exactly do these devices function mechanically? Are we talking about like optical sensors or localized Wi-Fi beacons? How do they track a human body without violating biometric privacy laws?
That's the trick. The industry standard relies on localized edge computing. The devices utilize optical sensors and computer vision, but to ensure privacy compliance, they do not record video or capture personally identifiable information.
So no facial recognition.
Exactly. Instead, the edge processor instantly translates the visual data into anonymized bounding boxes. The system recognizes that a human has entered aisle 4 and stopped in front of the cereal display.
It maps the physical shopper journey in real time?
Exactly. When the sensor registers the presence of a shopper, the localized display dynamically triggers a targeted advertisement for a specific brand of cereal. The shopper picks up the box.
Okay.
But the critical piece of the architecture is the back-end integration. Creative Realities software platform is deeply integrated directly into the retailer's inventory database and localized point-of-sale, or POS, system.
So when that specific shopper walks to the front of the store 3 minutes later and scans that specific barcode at the register, the system connects the localized database query.
The loop closes. The system generates an irrefutable data log, proving that the targeted impression in aisle 4 directly resulted in a transaction at the register.
Wow.
The retailer can then take that granular data back to the consumer packaged goods brands and charge massive premiums for their in-store digital ad inventory because they are no longer selling estimations. They are selling guaranteed, measurable conversion.
And according to the CEO, no other digital signage integrator has managed to deploy this specific closed-loop architecture at this massive 60,000 device scale anywhere in the United States.
If Creative Realities can execute this deployment without widespread network failures or data integration bottlenecks, it ceases to be just a lucrative contract. It becomes the definitive reference architecture for the entire retail industry.
Because everyone wants that data.
Every major grocery and big box chain in the country is desperate to monetize their foot traffic through retail media networks.
It effectively transitions creative realities. They are no longer a low-margin digital sign installer. They become a highly integrated, critical data infrastructure provider.
And Wall Street applies vastly different valuation multiples to hardware installers versus data infrastructure platforms.
So having comprehensively mapped the brutal reality of the Q1 headline numbers against the explosive mechanical potential of the forward-looking guidance, the Titan Stadium network, the AMC programmatic lobby rollout, the Dairy Queen retrofits, and the transformational RMN whale architecture, we must synthesize this data into an actionable framework.
We must.
So what does this all mean for you if you're holding or considering this stock? How should an investor weight the historical losses against the projected pipeline? What is the definitive analytical stance?
Looking purely at the operational mechanics and the contractual pipeline, the data supports a highly bullish framework, provided you have a multi-quarter time horizon.
Bullish, despite the $8 million net loss.
The $8 million net loss is a superficial terror.
Superficial.
Yes. When you isolate the specific drivers, the $4 million in GAAP deferred revenue trapped by winter weather, the highly specific $500,000 penalty to sever a redundant contractor, and the temporary violently inflated G&A overhead required to digest the 250 CDM employees, it becomes clear that Q1 was a localized anomaly. It represents the absolute chaotic floor of a massive corporate integration phase.
It was the necessary operational friction to rebuild the chassis of the company.
Exactly. What investors must monitor is not the lumpy quarter-to-quarter hardware revenue, which will always be susceptible to supply chain bottlenecks and localized weather delays.
So what should they watch?
The definitive metric dictating the long-term enterprise value of this company is their annual recurring revenue, or ARR.
The SaaS subscriptions, the high-margin, sticky capital that rolls in automatically regardless of whether a blizzard shuts down construction.
Exactly. The earnings data reveals they currently operate with a $20.1 million ARR run rate. Furthermore, they already have an additional $4 million in SaaS contracts signed and waiting in the backlog to be activated by the end of the fiscal year.
That means they will enter next year with a guaranteed baseline of $24 million in high-margin revenue.
Yes.
That ARR covers a massive percentage of their fixed operational overhead before they ever sell a single piece of new hardware.
They are successfully executing the transition from a highly cyclical, project-based hardware installer into a predictable, recurring revenue software platform.
Right.
As the $10 million in post-merger cost synergies fully materialize on the income statement, that operating leverage is going to expand aggressively, making those high teens EBITDA margins highly probable.
However, we operate on a mandate of objective analysis here. We cannot simply extrapolate a bull case without defining the specific failure points.
Of course not.
What is the localized risk factor that could derail this transition? What must an investor actively monitor in the upcoming filings?
The most acute operational risk was buried in a brief comment the CEO made regarding his CFO's workload.
Oh, I caught that too.
The final and arguably most dangerous hurdle of the CDM integration is the migration of all legacy financial and accounting data onto Creative Reality's centralized NetSuite ERP platform, scheduled for Q2.
ERP stands for Enterprise Resource Planning. It is the central nervous system of a corporation's data architecture, governing everything from supply chain inventory to accounts receivable.
Corporate history is littered with companies that crippled their cash flow during an ERP migration.
Oh, it's brutal.
You are essentially attempting to swap out the foundational pillars of a skyscraper while the tenants are still running their businesses inside. It requires meticulous data mapping.
If the schema mapping between the legacy CDM software and the new NetSuite environment is flawed, what happens?
You risk catastrophic cascading failures. If customer contracts don't map correctly, the automated billing engine fails to trigger. You suffer invoicing blackouts.
Which means you aren't getting paid.
Exactly. You lose track of hardware inventory across multiple regional warehouses. Accounts receivable age out because invoices are sent to incorrect localized contacts.
And if a company fails to issue invoices or collect cash during a massive deployment phase, the liquidity crisis can be instantaneous.
The CEO expressed absolute confidence, noting that their technical teams have executed similar migrations in the past. However, as an investor, you must remain vigilant. If they announce a delay in filing their Q2 or Q3 numbers, or if they are forced to restate earnings due to an accounting software reconciliation issue, that is an immediate, glaring red flag.
A huge red flag.
The market routinely punishes equities for back-end accounting glitches, regardless of how strong the underlying sales pipeline is.
That is the definitive warning. Monitor the NetSuite integration closely. If they clear that technical hurdle, the runway is clear. To summarize the architecture of this deep dive, the Q1 financials reflect the acute temporary pain of a massive merger and extreme weather delays.
Right.
But beneath that messy surface, the transition toward a high-margin, recurring revenue tech platform is accelerating rapidly. They are capturing the infrastructure of NFL stadiums, cinema lobbies, thousands of quick-serve drive-thrusts, and pioneering the highly lucrative retail media network space.
Assuming they navigate the ERP software migration without a localized liquidity event, the structural mechanics of their pipeline heavily support management's bullish revenue projections.
We always want to leave you with an analytical framework to apply beyond the transcript, a provocative thought regarding the macroeconomic trends driving these specific contracts.
Consider the structural labor dynamics within the food and beverage vertical. During the Q&A, the CEO cited data indicating there are roughly 210,000 quick-serve restaurants operating with drive-thrus in the United States.
210,000.
Currently, less than 40% of those locations have upgraded to digital infrastructure. And that 40% is heavily concentrated among the mega chains like McDonald's and Taco Bell.
That leaves over 120,000 localized drive-thrus across the country still utilizing legacy analog infrastructure static plastic menus where employees physically, manually update pricing.
In a macroeconomic environment defined by severe localized labor shortages and rapidly escalating minimum wages, the operational inefficiency of an analog drive-thru is a localized death sentence.
You just can't compete.
Fast food operators are being forced to automate and digitize their throughput simply to maintain baseline profitability.
The question you must ask yourself is, when the next massive fast food conglomerate realizes they must digitize immediately to survive the labor crunch, does a post-merger fully integrated Creative Realities have the operational scale to absorb that massive infrastructure contract?
If their deployment logistics hold up under the weight of the Dairy Queen and Seven Brew contracts, they position themselves as the dominant vendor for that remaining 60% of the market.
Right.
And if they capture even a fraction of those 120,000 analog lanes, that $100 million revenue projection is mathematically just the beginning.
It is a phenomenal intersection of technology, labor economics, and corporate turnaround strategy. Thank you all for joining us on this deep dive. Keep scrutinizing the data, stay analytical, and we will catch you next time.